Welcome to the Deep Dive, where we take a close look at what really matters. Today, we're unpacking the first quarter 2025 earnings call for essential utilities. Our mission? To cut through the jargon and give you the insights you need.
The big picture here is, well, a pretty strong start to the year for Essential. They reported GAAP earnings per share of $1.03. That's up about 6% from last year.
Okay, $1.03. And that was driven by both sides of the business.
Yeah, exactly. Both the water and the gas segments performed well, contributing to that. And importantly, they're actually reaffirming their full-year guidance.
Oh, okay. So even with the strong Q1, they're sticking to the plan.
That's right. Still looking at $2.07 to $2.11 per share for the full year 2025. That compares to, I think it was $1.97 non-GAAP last year.
Right. And infrastructure spending, still a focus.
Absolutely. They reaffirmed the plan there, too, looking to invest between $1.4 and $1.5 billion this year. And they're already well underway, having spent about $270.5 million in Q1.
That's a lot of capital going into the ground. How are they funding that?
Part of it is through their equity program and at the market, or ATM program. It lets them sell shares gradually. They've raised roughly $210 million so far this year that way. They expect to do more, depending on market conditions, of course.
Got it. Okay, so let's dig into the Q1 results a bit more. Revenue was up significantly.
It really was, up 28% year over year, hitting $783.6 million.
Wow. What drove such a big jump?
Well, a few key things. Regulatory recoveries were a big piece, maybe 2/3 of that from gas, 1/3 from water. Then you had higher purchased gas costs. That was kind of split between higher volumes and higher commodity prices.
Okay, so costs they pass through, essentially.
Right. And then the regulated gas segment itself saw higher volumes just because the weather was more, normal compared to a warmer Q1 last year.
Makes sense. And what about the other side of the ledger, operating expenses?
Interestingly, O&M expenses were basically flat year over year overall.
Flat, with revenue up that much? How'd they manage that?
Well, a bit of a story of puts and takes. They did see increases in customer assistance surcharge costs.
Which get offset in revenue, you said?
Exactly. And also increases in employee costs, water production expenses. But those were offset by lower bad debt expense. That was related to recovering a regulatory asset from the COVID period.
Oh, okay.
And also lower costs for things like outside services and insurance. So, yeah, kind of a mixed bag that ended up flat.
Okay, so how did all these moving parts flow through to the bottom line, the EPS?
Well, rates and surcharges added about 17 cents to EPS. Higher gas volumes kicked in another 8 cents. And those lower expenses we just talked about added 2 cents.
Right.
Now, those were partly offset by lower water volume and some other factors. A key one was comparing against Q1 last year when they had a gain on sale from an energy project.
Ah, that comparison effect. Got it.
Yeah. And, they mentioned Q1 EPS was actually at the higher end of what they expected internally for the quarter. They typically see 50% of annual EPS in Q1.
And why was it at the higher end this time?
Partly due to that regulatory asset recovery helping out on the expense side. Looking ahead, they expect Q2 and Q3 to each contribute maybe 10-20% of the annual total. Q3 is usually the lowest, and then Q4 should be around 20-30%.
Good context on the seasonality. And they mentioned funding needs.
Yeah, they feel they've completed about 2/3 of their planned equity issuance for 2025 already through that ATM program.
Okay, good progress there. Let's shift gears to the gas business, Peoples Gas. What's happening there?
So Peoples Gas is the biggest natural gas LDC in Pennsylvania, over 700,000 customers, plus about 40,000 in Kentucky, a big operation with a rate base around $4 billion.
And their focus?
Safety and reliability are huge. A really interesting project is the full rollout of these Intellis solid-state gas meters.
Intellis, what's special about those?
They have automatic shut-off features, so big safety enhancement. They did a pilot with 30,000, and now they're rolling them out across almost the entire customer base, nearly 700,000 meters.
That sounds like a major upgrade. Anything else on the gas side?
Yeah, they implemented that Weather Normalization Adjustment, the WNA, last October.
Right, you mentioned that helps with volatility. How's it working?
Seems to be proving its worth for them and customers. It basically kicks in if the weather is more than 3% off from normal, adjusting revenue up or down to smooth things out. Given how variable weather can be, it adds predictability.
Makes sense. Now, you also hinted at something. Data centers.
Yes, this is quite intriguing. There's apparently significant interest in the Pittsburgh region for on-site power generation, specifically for data centers supporting AI.
On-site generation using natural gas.
Exactly. They're talking potentially huge scale, discussions involving up to 5 gigawatts of power.
Wow, 5 gigawatts is enormous.
It really is. And the idea is that natural gas from the local Marcellus and Utica shale is a cost-effective way to provide that power, especially given potential constraints on the electric grid.
So people's gas could see a lot more demand.
Potentially, yes. They're talking to data center developers, energy producers, pipeline companies, trying to figure out how to support this. It could mean much higher utilization of their distribution system, which in turn could help keep costs down for all their other customers too. So it's a potentially exciting development.
Definitely one to watch. Okay, let's talk regulation. Sounds like they had some wins in Q1.
They did. New water rates became effective in Pennsylvania back in February. That's expected to add about $73 million in annual revenue.
$73 million, okay.
Anywhere else?
Yep. Also, rate increases implemented in Ohio and North Carolina in Q1. Smaller amounts expected to bring in about $5.8 million annual combined. And then there are the infrastructure surcharges, or DSICs. They implemented those in Q1 in Pennsylvania and Ohio for water, wastewater, and Kentucky for gas.
And those add up?
Yeah, about $10.8 million annually from POH and another $500,000 from Kentucky.
Plus, Aqua North Carolina just filed a new rate case at the end of April, seeking a pretty significant increase.
So actively managing the regulatory side across the board. Any legislative updates?
Some positive movement there, too. In Texas, a bill allowing a future test year passed the House, which can simplify rate cases. Ohio passed a law setting deadlines for rate cases, adding predictability, and Virginia expanded eligibility for infrastructure surcharges for water and wastewater. Generally helpful developments for them.
Okay, let's turn to growth. Acquisitions seem central to their strategy.
They definitely are, especially on the water and wastewater side. Since 2015, they've added almost 130,000 customers and over $500 million in rate base through acquisitions.
Any recent deals?
Yes, they closed on a water system in Ohio and wastewater assets in Pennsylvania in Q1. They've also filed to acquire the associated water system in that PA town. And looking forward, they have 5 signed deals pending for water and wastewater systems in Pennsylvania and Texas.
5 deals, that's quite a pipeline.
It is. Those represent over 210,000 potential customers and about $340 million in purchase price. And that's excluding the large Delora acquisition, which isn't currently baked into their guidance.
Right, the Delora deal is separate. So overall, what kind of growth are they projecting from all this?
They expect long-term rate-based growth to average around 8% per year. That's a blend of about 6% for water and a faster 11% for gas, driven by that pipeline replacement work.
And that supports the overall earnings outlook.
Yes, they reaffirmed their multi-year EPS growth guidance of 5-7% annually through 2027. That includes the planned acquisitions, but not Delora, and it factors in investments like PFAS treatment and the gas pipe replacements. They also reiterated their commitment to a strong balance sheet and that 60-65% dividend payout ratio.
Okay, sounds like a clue strategy. Now, we did hear some Q&A highlights too. Maybe just quickly touch on those.
Sure. They're focused on finishing their 2025 equity needs, not really looking at 2026 yet, despite the strong share price.
Right.
They expect to file a Texas rate case soon, likely end of May. Expect complexities there since it's been a while.
Right.
PFAS remediation is going full speed ahead, still budgeting $450 million through 2028. But they noted ongoing testing might find more areas needing treatment.
Always a possibility with PFAS.
The data center discussions are still early days, exploring different models, no timelines yet. And the estimated underlying O&M growth is probably 2-3% if you normalize for one-offs.
Got it. Okay, that covers the core results and strategy. Now let's move to our This Is Not Financial Advice segment. We look at the information and spin out some, let's call them outrageous but plausible trade ideas. Just food for thought, remember. Okay, idea number 1, focusing on that data center growth potential we discussed. Given the potential surge in natural gas demand from AI data centers in essentials territory and maybe some grid limitations pushing towards gas, consider this: a long position in essential utilities itself, paired with a long position in a natural gas pipeline operator that's heavily invested in the Marcellus-Utica region. You're playing the potential increase in gas throughput and maybe even new pipeline builds. The outrageous part, it's a very concentrated bet on that specific regional dynamic really taking off and driving infrastructure investment.
Idea number 2 focuses more on the regulatory side. We heard about positive legislative moves in several states for essential future test years, rate case deadlines, surcharge expansion. So consider this.
Go long essential utilities, but simultaneously short a different utility company operating in a state known for a, let's say, challenging and slow regulatory environment. You'd need to research to find a suitable candidate there. The outrageous bit here is betting directly that the relative speed and friendliness of regulatory outcomes will be a major differentiator for stock performance in this sector.
So, wrapping up our deep dive, essential utilities showed a strong Q1, reaffirming guidance and investment plans. They're active on the regulatory front, pursuing growth via acquisition. And that emerging potential around data center demand for natural gas is certainly, well, something to keep an eye on for the future of their gas business.
What stood out most to you from this deep dive? Remember, do your own homework, your own analysis. Join us next time on the deep dive as we unpack another crucial earnings report.